Hey guys, what's up? It's your name with financial freedom, and let's be real. Who doesn't dream of having $1 million portfolio? It's a goal that signifies financial security, the ability to pursue passions, and frankly, just peace of mind. In this video, I'm going to show you the 3 factors to work on to build $1 million portfolio. We're not talking about some get-rich-quick scheme, but rather the fundamental building blocks that can set you on the path to significant wealth. I'll break it down on how you can actually do it, regardless of whether your goal is to have $1 million portfolio by the end of next year or by the end of your life. So, whether you're just starting out or looking to optimize your existing investments, stick around because this video is for you. The first, and arguably most powerful factor in building wealth, is time. You've probably heard the saying, time in the market beats timing the market, and let me tell you, it's not just a catchy phrase, it's the truth. The longer your money is invested, the more opportunity it has to grow, and this is where the magic of compound interest comes in. Imagine this, you invest $10,000 today, and it earns a 7% average annual return. After the first year, you'd earn $700 in interest. Not bad, right? But here's where it gets exciting. In the second year, you're not just earning interest on your initial $10,000, but also on the $700 you earned in interest the year before. That's compound interest at work. Your money is literally making money on itself. Now let's fast forward 10 years. With that same 7% average annual return, your initial $10,000 investment would have almost doubled to nearly $20,000. Fast forward another 10 years and you're looking at over $40,000. And after 30 years, you'd have over $80,000. That's the power of compound interest over time. The earlier you start investing, the more time your money has to compound and grow exponentially. Even if you're starting small, consistency and time are your greatest allies. Think of it like this. Someone who starts investing $100 a month at age 25 will have significantly more money at retirement than someone who starts investing $500 a month at age 45, even though they're investing less overall. Now I know what you might be thinking. But Graham, what if I'm not a stock market whiz? What if I make bad investment decisions? And that's a valid concern. But here's the thing. Even if you make some mistakes along the way, the power of time can help mitigate those losses. Think about it. If you're investing for the long term, say 30 or 40 years, a bad investment decision in year 5 might sting a little, but it's not going to make or break your portfolio in the grand scheme of things. You have ample time to recover, learn from your mistakes, and make adjustments to your strategy. The key takeaway here is that time is your most valuable asset when it comes to building wealth. Don't get discouraged if you're not starting with a huge sum of money. The most important step is to start investing consistently as early as possible. Let time work its magic and you'll be amazed at the results. Now, let's talk about the second crucial factor, returns. Returns, simply put, are the profits you make on your investments. They're the fuel that propels your portfolio towards that $1 million mark. Now, I know what you're thinking. Graham, just tell me how to get the highest returns possible. And trust me, I wish it were that simple. But there's a crucial balance to strike here. Risk and reward. Generally, the higher the potential return, the higher the risk involved. Think of it like a roller coaster. The taller and faster the ride, the more thrilling and potentially terrifying it can be. So how do you navigate this risk-reward tightrope? Well, it all comes down to your individual risk tolerance, investment goals, and time horizon. If you're young and have a long time horizon, you might be more comfortable taking on more risk for the potential of higher returns. On the other hand, if you're closer to retirement, you might prioritize preserving your capital and opt for lower risk investments, even if it means potentially sacrificing some growth. Now let's talk about a concept that beautifully illustrates the power of returns. The penny doubled every day for 30 days. It might sound underwhelming at first, but trust me on this one. On day 1, you have a single penny. On day 2, it doubles to 2 cents. Day 3, 4 cents. You get the idea. Now you might be thinking, Graham, this is going painfully slow. When do I get to the good part? Well, here's where it gets interesting. By day 20, you've crossed the $5,000 mark. Day 25, you're over $167,000. And by day 30, that single penny doubling every day turns into a whopping $5.3 million. Now, I'm not saying you'll find an investment that doubles your money every single day. That's just not realistic. But this example perfectly highlights the exponential power of compounding returns over time. Even small, consistent gains can add up to significant wealth in the long run. So, how do you actually achieve those returns? Well, there are countless investment strategies out there, and the right one for you will depend on your individual circumstances. But here are a few key principles to keep in mind. First, diversification is key. Don't put all your eggs in one basket, as the saying goes. Instead, spread your investments across different asset classes like stocks, bonds, real estate, and even alternative investments like art or collectibles. This helps mitigate risk and potentially enhance returns. Second, consider index funds or ETFs. These are baskets of stocks or bonds that track a specific market index like the S&P 500. They offer a low-cost, diversified way to invest in the market and have historically delivered solid returns over the long term. Third, don't underestimate the power of real estate. It's a tangible asset that can provide both cash flow and appreciation potential. Whether you're investing in rental properties, REITs, or even crowdfunding platforms, real estate can be a valuable addition to a diversified portfolio. And finally, remember that knowledge is power. The more you understand about investing, the better equipped you'll be to make informed decisions. Read books, listen to podcasts, take online courses, invest in your financial education, and it will pay dividends in the long run. Chapter 3. Money fueling your portfolio. Now let's talk about the third and final factor in building $1 million portfolio: money. I know, it's not always the most comfortable topic to discuss, but let's be real. You can't grow wealth without having some money to invest in the first place. But here's the good news. You don't need to be rolling in dough to start building a substantial portfolio. Remember the power of compound interest and consistent contributions we talked about earlier? Even small amounts of money invested regularly can snowball into significant wealth over time. Let's compare two scenarios to illustrate this point. Scenario 1, you start with a hefty $950,000. Now, assuming a modest 2% annual return, you'd hit that $1 million mark in just a little over 2.5 years. Not bad, right? But let's look at scenario 2. You start with a more modest $10,000 and contribute an additional $300 per month. Now, let's bump up the annual return to a still achievable 7%. In this scenario, it would take you around 20 years to reach that $1 million milestone. Now, I know 20 years might seem like a long time, but think about it. That's less than $3,000 a year turning into $1 million. And remember, this is just an example. By increasing your contributions, finding ways to boost your returns, or even a combination of both, you can significantly shorten that time frame. So how do you actually free up more money to invest? Well, it all starts with taking a hard look at your finances. Where can you cut back on unnecessary expenses? Can you negotiate lower rates on your bills? Are there any side hustles you can explore to generate additional income? Remember, every dollar you save and invest is a dollar working for you, potentially earning you even more money in the future. It's like planting seeds. The more you plant, the more you can potentially harvest down the line. And here's a little secret. You don't need to make drastic, life-altering changes overnight. Start small. Maybe you commit to cutting back on eating out once a week and invest the money you save. Or perhaps you explore freelance opportunities in your spare time to generate an extra stream of income. The key is to be consistent and make investing a non-negotiable part of your budget. Treat it like any other essential expense like rent or groceries. Automate your contributions if you can so you're less likely to skip them. Remember, building wealth is a marathon, not a sprint. It's about making conscious, intentional choices with your money today to create a more secure and abundant future for yourself. So start small, stay consistent, and never underestimate the power of even a few extra dollars invested wisely. So there you have it, the 3 key factors to building $1 million portfolio: time, returns, and money. Remember, it's not about trying to get rich quick, but rather about making smart, strategic decisions with your money over the long term. Remember, investing has risks, and you're never guaranteed to make money. Always do your own due diligence. Don't be afraid to seek guidance from a financial advisor if needed. They can help you create a personalized plan tailored to your specific goals and risk tolerance. If you want to stay updated on the market, check out Market Briefs, our free daily newsletter that breaks down what's happening in the economy, housing market, stock market, crypto market, and global economy. It's a valuable resource to help you stay informed and make more informed investment decisions. Links to join Market Briefs and other resources mentioned in this video are in the description below. Thanks for watching, and remember, the best time to start building your $1 million portfolio was yesterday. The second best time is today.